to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Jim Riggio and our special guest Steve Lentz today from Discover Options. Before we get started, we have a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you care to read it in its entirety at your leisure. So while we're switching the presenters to Steve, now that we're finally recording, Steve, welcome to the roundtable, and it's a pleasure to talk to you again, and we're really looking forward to your presentation, but you might want to take a second and just tell people who you are in case they're watching the recording or don't know who you are.
Oh, certainly. Thanks so much, Tom. I'm Steve Lentz. I'm with Discover Options. We are the educational arm of OptionView Systems. OptionView's been in business since 1983, exclusively in the world of options analytics software. And then back about, 8-9 years ago, we started our mentoring educational arm called Discover Options, and that's focused exclusively on one-on-one mentoring. And my role is the curriculum developer, the presenter, do a lot of research, and then we have a team of professional options traders who are mentoring kind of on the side, and I kind of coordinate the whole thing, and we do, I think, a very unique and real fine job of getting people from, say, the beginning intermediate level to the advanced, even professional level. And so today I want to just go over a little bit about some of the research that we're doing. I would call it original research in the world of volatility. Now let me go over here. Should I just go ahead, Tom, and go? Should I just...
Yeah, you've got the ball, so go ahead and
Perfect.
share your...
There we go. Sharing my screen here, so then I'll hit F5, and I think you should see the full-blown, there we go, volatility edge analysis of the Russell 2000 index. Beautiful. And so, you already did this disclaimer. I don't need to go into that too much. So what I want to do is just kind of explain a little bit about an angle on volatility research that I've been pursuing. And it kind of started last year. I did something called statistical edge analysis, where I sought to examine directional strategies and whether or not they really provided an edge or not, or whether you could just flip a coin and pretty much have the same kind of outcome. And so a lot of my presentations last year to our students were centered around that, and it was amazing how many technical analysis approaches really don't do any better than just flipping a coin. And so this year I wanted to address volatility from somewhat of the same perspective in terms of discerning what assets have options that give the option seller an edge and which ones really provide a disadvantage. And so when you look at a volatility chart, and this is a typical volatility chart. This is one in OptionView, and the blue line represents the 30-day implied volatility, and then the red line is statistical, or what many call historical volatility. And when you look at these, you'll note that the implied volatility is always really a measurement of what people expect from the future. What's the future volatility going to be of the underlying asset? It's the volatility implied by the time premium and the cash options on the Russell. Now the red line, the statistical volatility, is a measurement of the past. And in this case, it's 20 days, 20 bars. So the blue line is a predictor of the future. The red is a measurement of the past. And really, what does this mean? And a lot of people a lot of educators, a lot of research, they go into these, they go into percentile rankings, decile rankings, this, that. I've examined the trend of statistical and came out with my own indicator on that. And so I'm taking a fresh look at it this year And going down this path, and I'm adequate enough at Metastock to be kind of real dangerous with it, and so that's what I'm kind of get into here today a bit. So, what is volatility edge analysis, and we'll apply it to the Russell? Well, it's 4 steps involved. First, we're going to understand the implied 30-day move, not the volatility level expressed as a percentage, but what is the actual move being implied by the options. Then we want to understand what actually happened after that point. So the options are implying a certain move of the future. Then we're going to examine what actually happens from that day forward. We're going to try and bring the blue and the red line kind of in alignment a little bit more. Then once we determine what we want to do then is determine the historical distribution of those 2 types of volatility. All right? So we want to see if, this is the 3rd time I've been expressing this in a webinar like this, so bear with me here, and I'll want to slow down to make sure we got this. So there's going to be times, and you'll see this in a bit, when the options imply a move greater than what actually happens, and at times also when it implies a move that is less than what actually comes about. And we want to examine the distribution of that relationship. And if once we know that, we can determine if there's an edge, a baseline volatility edge to the premium seller. Those that are doing condors, butterflies, or doing the campaigns of those. Everyone has their secret sauce, so to speak, as to using butterflies and calendars, but more condors and butters. But we're doing the backdrop. Now then, after we have the baseline edge determined, if there is one, now we can then look at certain technical setups. And today I want to examine just a 40-period simple moving average. All right, now when we say an implied 30-day move or an actual 30-day move, that's the calendar. I'm using 21 trading days. Okay, and you could go 22 if you want. I'm sitting at 21. A lot of the historical and statistical volatility uses 20 days. So it's 21 bars. So here we go. We're going to go to the implied 30-day move and examine that first. All right, so this is as of March 12th. That's when I did this benchmark research here last month. So you have a price chart of the Russell, and then you have the corresponding VIX type published volatility number for the Russell, and this is the RVX. It's the 30-day implied volatility of the cash options, and it's published from the CBOE. It's along the same formula as the VIX, only it's applied to the Russell. So you have the RVX there for each one of these days, and what we can do is take the RVX, and we can then back into the implied standard deviation, all right, of the RVX. So if the RVX back on March 12th with the Russell at 1232, if the RVX was at 17.96, almost 18, all right, the 21-bar standard deviation is at 63.6. All right, and I'm giving you the formula down there. Of course, it's the close times the volatility, and then you take the square root of the days remaining divided by the days in the year. And then I broke it down, and you can kind of see how I use 21 days and 254. Now you can squiggle that around a little bit, use 22 and 252, and I messed around with that, the 21 and 254, to kind of back into you'll see what I did when I kind of compared notes with the probability calculators. Now, that 63.6, that's just in Russell points, right? Well, I wanted to back into that, and so to make it an implied 21-day standard deviation in terms of the percent move. So the implied 21-day move from the RVX is 5.2%. 5.2 is 63.6 divided by the 1232 or whatever it was, 5.2%. So that is the implied 21-day standard deviation from the Russell. Now let's confirm that with a probability calculator. Now there's a bunch out there. We'll look at a few others in this presentation. I like option views because we got some the probability of touching and the Monte Carlo thing going on at the bottom. But let's focus on the top if we could here a little bit. If you take the current price of 1232 and this future statistical volatility, the RVX was at 17.96, it rounded. Okay. The standard deviation going up turned out to be 65.1 points. On the downside, it was at 61.8. Now, remember, we backed into 63 point, what is it, 4 or 6 or something like that. So basically, you have in this case, the upside is farther away from the current price than the downside. And so I'm told you guys are all pretty much intermediate, advanced level folks, so you know that that's due to the log normal distribution within the formula, right? So what I wanted to do, and ideally I guess I could apply an asymmetrical distribution. I just backed it off so that we're kind of going in a normal distribution because these indexes are, I think at the end of the day we could go normal, and then some folks even want me to go asymmetrical on the other side because the puts are more expensive, so we should lean it downside. So let's just go normal for now, and I'm kind of backing into a number here kind of right in the middle, 63.45. So the probability calculator kind of confirms that the formula, the 21 days, 254, kind of gives us a good distribution there to use. So I hope we now understand the implied 30-day move. It's coming from the RVX, and we're applying a certain percentage move in the next 21 bars, 21 trading days. All right, now let's set that on the side, and let's now go and understand the actual 30-day move, what actually happens. Okay, because the two are entirely different. I just don't like looking at the blue and the red line. I want to know at the end of the day as a premium seller what the options are implying, and then how far the darn thing actually moves. That's what really matters. So what I did is, this is where I got dangerous in Metastock, all right? Down at the bottom here, this is Metastock, Russell at the top, down underneath, is the actual 21-day max movement percentage from the close. So I'm going to show you two examples of this. And then we're going to, at that point, we'll then bring in the blue line and compare the two. All right? Actual 21-day max movement is a percentage from the close. Let's just take an example. I'll give you two here just so we understand this. Okay, so if we go back to December 29th, the close of 12/19, and we're going to go forward 21 days. How far did the market move away from that close? What was the maximum movement during the course of the next 21 days? And we can see down there over the next 21 days, that is the low there, 1151.3. What is the percentage movement on that move? It didn't move to the upside, really, I mean, just a few points, but then primarily it moved to the downside, and you can kind of see when you crunch the numbers, it moved down 5.56%. And you can kind of see I just crunched the numbers there. It moved down 67.82, and that was 5.56 of the close up there. And then so Shazam, over there in the red line, you can see 5.56 is the value for that particular day in December 29th of last year. Okay? Now that was an example of a downside move. Let's look at an example of an upside move. So let's go to this date here. This was February 11th, I believe. And how far did the market move from there? What is the maximum move? Well, it clearly moved up much farther than it moved down from that particular close. And so we're going to go ahead and look at the high from that move. And when we calculate the numbers, it moved up 3.48%. And so that's the value in the red line down at the bottom, 3.48%. All right? So now at this point, let's overlay on the bottom down there the blue line. What was the RVX implying, all right, when this 3.48 occurred? If we go back in time to February 11th, what was the blue line implying? All right, and there it is. I'm bringing in the blue line. It had an implied move on that date of 6%. 6%, that's what the RVX was implying. Now, as a premium seller, we could sell premium a standard deviation out of the money, and then and so let's just examine what kind of edge does this represent. So if you were to take 6% from that close, the close on the 11th there was 1202. 6% on the upside puts us at 1274. It actually moved only 3.4%, going up to 1243. Clearly, we could have sold premium a standard deviation out of the money at 1275 or so, and it didn't. It fell way short of making it up there. So clearly, we can see as we look in the past, the actual move fell far short of what was being implied there for that particular close. All right? And my question as a premium seller is, for the Russell, or any given market, but we're dealing with the Russell, how often does this actually occur? How often does the RVX and the options, how often do they imply a much greater move than what actually occurs in the underlying Russell? And so what I did is I went back for every close, going back to when RVX began being published, examined every close moving forward, and just ran some stats on this thing. Okay? So how often was the implied move higher than the actual? And this brings us to our third point. We're going to determine the historical distribution of these two types of volatility understanding. And we're going to see if there's a baseline edge that we can extract from it and make a conclusion. So this screen here is kind of, there's a bit packed in here. So let's just start, well, in the middle. All right, 5/5/2000. The RVX began to be published May 5th of 06. And I ran this study as of March 12th of 15. During that time, and you can kind of look up at the above blue and red lines there, the actual volatility was less, the actual move was less volatile than the implied 1,444 times. Okay? The actual move was more drastic, more volatile than the implied 769 times. All right? So if you look down at the very bottom, you can kind of see the way we understand that is whenever the blue line was above the red, we know that the move of the Russell failed to move the full standard deviation being implied by the RVX. Okay? When the red line is above the blue, in those moments, for those particular days, the RVX moved greater than what was being implied by the RVX. Okay? So clearly, in the course of time here, the RVX was implying a move much greater than what actually occurred by the Russell. And so as a percentage, okay, the 1444, what's the percentage of the total there? And I ran that, and that's 65% of the time. 65% of the time, the RVX implies a move greater than what actually happens. 35% of the time, okay, the actual move of the Russell was greater than what was being implied. Okay? Now, how significant is this? Is this good, bad? Is it, you know, how different is this than what you would expect just raw statistically. So to answer that, we need to go revisit some probability calculators and just understand what the probabilities are of the market moving and touching a standard deviation away. So let's go and visit. Oh, and I wish I had labeled. I posted this, and this is what's the name of it? I want to say, is it Hodel, or what's the guy's name that did this one?
I think it is.
Yes, that's right. So I went over there, and he gives you like 15 calculations per hour, because he doesn't want people to burn up his server. That's it, John. This is the Hodley calculator. And it gives you 15 calculations an hour, and I burned through mine pretty quick getting to this screen. But I'm taking and he gives you just kind of some set things in there. But the bottom line here, the probability of touching either is I plugged in the standard deviation levels, okay, the upper and lower boundary prices, and well, let me just review this again. I blew through this. I've presented this one time, and now I'm finding myself at a loss here. Probability of price being between the boundary prices. So you can see down at the bottom, we're pretty darn close to that 68%. The Hodley in the square above it in red, it says probability of price touching either standard deviation, 63.43%. So if you're taking notes at all, just write down that number, and we'll come back and visit it a little bit. And so Hodley is saying that the probability of price touching either standard deviation is at 63%. We'll just round down, 63%. Okay? So that's Hodley. Let's go and look at Trade King. They have one online for free. So I ran this same thing. The probability of touching either you can see on the right there, I circled it in red. The probability of touching one deviation or the other is about 35 plus 29. Okay, 35 plus 29, that's about 64%. That's pretty darn close to the Hodley one. Maybe they're using the same engine. All right, it's a small world out there. People communicate quite a bit there. So now let's go to option views now. Option view is using a Monte Carlo engine, which is going to be different. It runs iterations to get into this. And we'll just cut to the bottom line here. The probability of ever touching the lower standard deviation, 26.5. Probability of touching the highest is at 27. You add those up and you have 53%. That's a lower value than the Hodley or the Trade King. Okay, so let's just assume that the Monte Carlo engine, and I'm pretty sure that Macmillan uses the same engine in his calculator that we do. It's a similar Monte Carlo approach. But you can see in the bottom left, I say, what's the baseline expectation? So the baseline expectation you have, I'll express this as slowly and clearly as I can, is making sure I get this right. If the Russell were to move at the same volatility level as the RVX is implying, if the two were congruent, you would expect then that the actual volatility would be more the actual move would be more than implied 53.5% of the time. The market would move and touch one of the standard deviations 53.5% of the time. The other calculators think 63, 64. Monte Carlo says no. When you run the iterations, it's much lower at 53.5. Okay? And that it would stay in the middle. It wouldn't touch any of those 46.5% of the time. Now, let's look at what the Russell actually did. When we actually look at what the Russell was doing, we find that the Russell was staying in between and not touching those deviations 65% of the time. Much greater than the 46.5 that the calculator says would be expected if they were congruent, but they're not congruent. In reality, it would appear that you have around an 18.5% edge as a baseline selling edge, okay, with regards to the Russell and what the options are typically implying. All right, and I think that's kind of why, I mean, people intuitively, they gravitate to the Russell, and the SPX is a similar number when you run that out, but you can kind of see here we're documenting and that there is, in fact, an edge to the premium sellers. So that's the baseline edge that we understand.
Steve,
okay? Yes.
Have you broken down that edge on the downside versus the upside?
That would be an iteration yet to come. Absolutely. And I did that with my directional stuff. The directional stuff, I was examining what would happen after a certain technical signal. Would it go down and hit the lower deviation or standard deviation less or more often? Okay, and I haven't yet taken the iteration to this at this point. But
and I assume that
has absolute valid.
Have you looked at it from a seasonal or from a monthly perspective?
I have done some seasonal work. I did it with SPX. I did it last year, and I did it on a weekly basis. I wanted to examine which week of each month was more volatile than other weeks. I didn't do it using this methodology, but I'll just cut. We're kind of going to digress, and then we'll come back. But the seasonal work I did revealed that the week just after the labor report came out was indeed the lowest week of volatility of the 4 weeks in the month typically, and that the week leading up to the labor report was the more volatile of the 4 weeks, which it makes sense. I just happen to document it. Now, is the difference a tradable quantity? That's the part I'm not convinced that there's a difference of enough to make it much of give one a trading edge. But if you're going to favor 1 week over another, and this is what we do in our mentoring program, we do kind of gravitate towards the week just after labor report comes out. And it comes out typically on the first Friday every month.
Yeah, it was also interesting from a seasonal perspective. Somebody showed me their recent copy of McMillan's Options as a Strategic Investment, and I didn't see it in there. But in the first version that I had, which was version 3, by the way, he had done, I don't know what are we on, 7 or 8 at this point. Anyway, what he had done is there wasn't obviously, weekly options back in 1999 when I bought the book. But what he did show was the monthly options. And the 1 month out of the year, the one expiration out of the year where actualized volatility 30 days offset the way you've done. He did the exact calculations that you did. The October expiration was the only month. September was very close, but October expiration, meaning half September month, half October month, was the only month where we actually had more volatility than the options were implying we would end up having.
Mm-hmm.
So that's why I ended up asking if you had done any seasonal work. It is quite interesting. And I know a lot of this has changed over the years, so I'd be very interested. I mean, you've kind of hit, in my opinion, the essence of what we do. If you're going to end up putting on an options trade, basically you're saying, I think volatility is going to be more or less than the market's implying. That is the single probability bet that you're making.
Yes. Yes, and what I want to do is to use this methodology to then examine technical analysis setups to try and do something better than that 18.5 baseline edge. Okay, so we know that inherently the Russell gives us an edge just by, historically we're seeing the RVX is typically higher than, and implying something that more than what actually comes to pass more often than one would expect. If things were, if the two volatilities were congruent. And so what I wanted to do is to take this engine that I have now in Metastock to now examine, okay, what technical conditions exist that would take my edge even farther than this? Okay. So that's kind of where I'm going. Can I keep going? And Jim, do you want to continue, or I don't know?
No. Thank you very much.
Oh,
I just
okay.
wanted to,
I find it, yeah, the seasonal thing I got to figure out. In my head, I'm going, okay, how can I do that in Metastock? Because I isolate October and look at the other. I did it in a spreadsheet. I had to go nuts in Excel and
yeah,
import
that's the way I've
the
done
data.
most of the work also. You can only use so much of it until the rest of you always have to do it in spreadsheets.
Yep. You go into Excel and then you go crazy, and then you got to get rid of the vacation days and all the holidays and line them up, and it's a nightmare. It takes forever, but
No, this is great stuff. Please continue.
Okay, so now we have the baseline edge of 18%, all right? So now we're going to try and go after a technical setup to better that even more. So we're going to look at the historical distribution of the two after a setup occurs. So here you're looking at the Russell, and you look at where the historical move, the red line, is higher than the blue. We're going to paint those bars red. And when the RVX is implying a move greater than what actually occurred, we're going to paint those bars blue, meaning that the implied won out at that particular time. The red means that the move of the market won out on the race to determine if it went more or less than a standard deviation. Now, if I were to back out and look at the blue and the red, clearly there's more blue lines than red. But as a premium seller, I want to really emphasize the blue. I want to try and, emphasize the blue. On the far right side, of course, the bars are black because, of course, we don't know what's going to happen in the future. So those are black. But if we were to look in the past and just, and this is my first real stab at looking at a technical setup that can give me a good edge. One thing I notice is that if we take a moving average, and I backed into a 40-period moving average here, I want to try and isolate those red lines and make sure that if I'm going to do a condor or a butterfly, I don't put my butterfly or condor on when it's likely to be red. And if you cut the data through with a 40-period simple moving average, you'll see that quite often when the bars are underneath the moving average, there's a lot of red bars underneath that moving average. It seems to cut out quite a few of the red bars by just saying, okay, if it's under a moving average, if it's under that 40-period moving average, we won't put on a butterfly or a condor. It's going to have to be above the moving average. So what I want to do now is I went and examined the distribution of the red and the blue lines when they were above the moving average. Okay, just trying to find if we can beat that 65%. And sure enough, okay, when you run those numbers, we see that when the data is above the moving average, okay, 70% of the bars above the moving average were blue, meaning that the RVX was implying a move greater than what happens. 30% of the bars above the blue. Now this is going back to 2006. Remember, we're going back to 2000. So we're only looking at the last few years here. So, but only 30% of the bars were red. Maryland, I'm using a 40-period simple moving average. 40-period simple moving average. And so you can see then, and then I created my little indicator in terms of an edge. So the edge for the premium seller is 5% above the baseline here. And that's pretty significant, I think. So if you're going to put on a butterfly or a condor, you would want to favor the day, putting it on at a time when the data is above, when the price is above the 40-period simple moving average. If you're putting it on when it's underneath the moving average, okay, well, you're putting it on at a moment in time when there's a probability that there's a higher probability that the market is going to move and strike one of those deviations there. So I found that kind of interesting. I'm examining, other possible patterns that can isolate, or I just want to clear out the red lines more and more. And so that's kind of the adventure I'm on as the year got started. Here we got the engine, and now I'm examining other ways to clear out the red lines, isolate those, and focus in on trying to predict when one of these black lines on the right, black bars on the right, particularly today's, is likely to be blue or red. And so that's kind of the presentation I have. That's kind of the research that we're doing here and the lines that we're going, the roads that we're pursuing. But the 40-period moving average seems to be a good starting point. It cleared out quite a bit there, and we can certainly, I'm going to keep going and try and rub out those red bars as best we can.
Hey, Steve, have you looked at any different period lengths, like to something for weeklies or even longer ones, like say 30 or 40 or 50 days?
You mean on the RVX?
Yeah, on your 21-day period, have you changed that period at all and looked at any of those numbers?
Well, the issue there is that I need to look at an asset that has a published VIX type number, and the only one that has something other than the 30-day number would be the SPX, which has a corresponding VIX. And they have VIX values now for, longer than 30 days and shorter than 30 days. They've expanded on the VIX. So I could do it for the SPX, but for none others. And I've focused in on just the 30 days, only because you now have similar VIX type published symbols for, I think they've got 5 stocks: Google, Apple, Goldman's, IBM, Microsoft, I think. They have published VIX numbers for those options. There's a number of futures. There's a number of ETFs as well. And so until I clear those markets out and go down this road, I could maybe come back to the VIX and the various values it has for the SPX. But that's certainly, you could see I have my year cut out for me here.
Yeah, good research so far, though.
Yeah, I think it's interesting. I'm just trying to figure out how to clear out the red, and we always want to try, and if you could just sell a condor standard deviation out and have right now we're up to a 70% probability that the market won't touch either one. Just make sure it's above the 40-period moving average, and if we can throw in some other factors and narrow it down to 80 or 90, I think we'd be looking at a even better situation.
Absolutely. Does anybody have any questions for Steve? And Jim, have you guys looked at anything like this for your institutional guys?
We very much have. What we tend to end up doing, Steve, is that we'll not only look at the stuff that you're looking at here, we'll end up also looking at it at price points. So we tend to end up doing this level of type of work, but we look at it very much on a skew level, meaning where's the implied volatility of what we're actually selling.
Mm-hmm.
Okay, because you do have your fractal distributions and stuff that you have to end up taking into consideration. And then what we'll do is that we'll take a look at how far things are off the norm. Like, for example, one of the things that happened in the first quarter several times is that we found that the implied volatility put skew on the indexes, like the SPX XPY, was extremely steep, meaning that the implied volatility of the puts below the money were much more expensive than the implied volatility of the puts at the money. that level of steepness, okay, was at a 3 standard deviation move. One of the things that we're also seeing is that, I don't know if you had a chance or if you looked at, there was a pretty good Goldman Sachs research paper in the fourth quarter that ended up showing that we had 2 of the 10 largest weekly VIX moves in its history. And it was introduced back in January, I think, 1990. So we're seeing this massive, movement these days because of, I think, all of this algorithmic trading. And so when we take a look at things and we take a look at models, I think that a Monte Carlo simulation where you have a weight towards what the recent data is much, much more important than doing any statistical analysis. So all of the statistical analysis models that we end up seeing are very non-directional. So what will end up happening is that when you take a look at it, like for example, selling calls has basically been a losing strategy for about 3 years. So if we're not going to be compensated, okay, we're not going to end up selling calls to end up paying from things. So, our insurance is going to cost us a little bit more. We might have a little bit more drag. But what's happened is that we've found and we've proven statistically that selling calls, if you're not being compensated and you give up that upside potential when we do end up ripping, will end up underperforming. So this is really, really good stuff, though. A lot of people don't end up realizing that, and I meant this when I said what you've kind of really hit the nail on the head of when people are trading options, they're basically making a bet that the actual volatility will be more or less than what the market is implying. And this is exactly what your study showed.
So if you were to cast a standard deviation up or down, right now I'm doing it, equally the same. And what you're talking about, I think, if I hear you right, is that you would favor calculating the lower standard deviation a little bit farther because the puts are implying more volatility down there.
Yes, but this is exactly right. But what ends up happening is your study had shown the market will end up going up more than it has gone down. So what happens is it happens less frequently, but when it does happen, you tend to get larger moves.
And so then would you, if you're going to sell calls and you're going to run a study like this, would you shave off something on the RVX for the upside and then add something to it on the downside?
Well, what we'd end up doing is that we look and see what the model has actually done in terms of, our percentage of what we're looking on the upside. Here's what we would end up doing in the actual implementation of it. What we might end up finding is that if we go out and we sell, oh, by the way, one of the things that Goldman Sachs report showed, and there was another one that ended up showing where they did I think it was like a 16-year study of covered calls. What they ended up showing was that using percentages out of the money were a better alternative than using deltas. Very interesting. And that's because, as the volatility goes up, if you're using the same delta, it'll push it further away from the money. If the volatility is very low, you'll bring it closer to the money. So what we'll end up doing is when we end up selling our calls, we may end up selling maybe, 1/3 or half as many calls as we normally would, but we'll bring them closer to the money. This way we still have a higher capture ratio if the market runs up, but yet we'll still have some income to help to end up paying for the hedge on the downside.
Okay, so, and you're reflecting the skew. There's a market expectation of the future movement, and it is definitely skewing it to the downside because of the higher volatility down there. Do you use the symbol, what the CBO has is the skew, SKEW? That's what I'm trying to do here. Is I'm examining, and some of our professional trading students wanted me to look at that, is taking the skew and then making the deviations asymmetrical, with the downside being farther away and the upside being closer in, like what you're apparently doing already with your in practice.
Right. Yeah. No. What we end up doing is that we have an institutional level tool that's pretty heavy-duty institutional level tool that ends up doing a lot of these things for us. We've had to end up building out specifically what we thought the model should end up being, and it's giving us, our information of is it cheap on the downside? Is it expensive on the upside, or vice versa? And what I can end up telling you is that for the most part, volatility on the upside has been cheap, and the skew on the downside has been very steep, meaning the below the money puts are a lot more. The other thing that we ended up seeing after we had that rather volatile December, when Goldman came out with that paper and they documented everything, what we found in January was that the term structure was also getting expensive, meaning the further we ended up going out, that we found that the implied volatility as a percentage on the SPX XPY options were more expensive. I had one client end up saying, well, if vol is this cheap, why aren't you buying put leaps? There's a whole reason why you don't go out that far, because you're not matching your risk properly, but they weren't that cheap. One of the things that people end up realizing is that if you go and take a look at what happens in real market turmoil when it drops, the 1 and 2 year implied the implied volatility doesn't go up anywhere close to what the implied volatility goes out in 9 days or 30 days.
Right.
You can end up seeing that in the short-term VIX, right? The VX ST or the longer-term VIX, the 3-month VIX, the VXV. But they don't even, right, they don't even give you, they give you a single number for that duration or that term structure. They don't tell you anything about skew.
Right, so you developed your internal skew calculate or tools in that sense, it sounds like, because the SIBO publishes their skew number, which,
right.
It kind of but it does it on one standard basis for the SPX. Interesting.
Right.
Okay.
Thank you for the compliment. No, but I didn't develop it. It was my partners who did the developing. As I end up saying, and this is true, I'm not smart enough to develop it. I'm just smart enough to understand what they did.
I hear you there. Well, I mean, but it sounds like what you're doing is intuitively you're kind of flowing with the flow of that skew to a certain extent, and that sounds great, because then you stay out of trouble on the downside a bit more, right?
Well, actually, the thing is that what we do as a firm is that we build institutional hedges for large portfolios.
Okay.
We build hedges for family office pension plans, hedge fund managers, and the like. So what we're tasked with doing is buying the most effective, efficient downside protection that we can find.
Mm-hmm.
Normally, as you kind of pointed out, is that you used to be able to end up making a lot of money, end up selling put spreads. But what's happened is that as the put skew gets steeper, your edge has gone away. And the reason why I brought up January was that, usually only after a market ends up tanking, okay, and then it starts to end up coming back, you end up seeing the skews get like this. And what we found is that when the skews got this steep, it was actually cheapest for us back in January and early February to buy 3-month put spreads, something that, I don't ever remember seeing in any of our models before. I mean, so the whole market it has changed, I think, pretty dramatically. I had read a lot of your VXX stuff, by the way, which I thought was absolutely great. And what ended up happening is that in our models, if you use data that's more than about 2.5 years, it's what the market was 2.5 years ago really doesn't reflect what's going on today. Things have changed so much in terms of the way the skew models end up working, and it changes. I mean, that has a really big impact if you're selling verticals.
So it sounds like you're buying bear put spreads as a hedge. Is that right? Because then you'd be taking advantage of the skew royally then.
That's what we did in January and February. It's not. I will tell you that probably over 95% of the time, the buying a put vertical, okay, is not the cheapest way to hedge.
Mm.
Okay, there are more effective ways to end up doing it to take advantage of term structure and playing the difference between one put skew and one expiration versus another that we'll end up using most of the time. So this was a kind of a rare occurrence, and what we're seeing is that because we're getting these this change in the way the models are working, I think that there's a lot more algorithmic trading that's pricing things, and they're pricing them a lot more accurately than they used to.
Mm-hmm. Well, that makes sense. Sure. Yeah, I mean, that's just the market working, and better information, better calculations, and more efficiency. Makes sense.
Yeah.
Interesting. Huh. So do you find the edge in the Russell and the SPX still exists today?
Well, here's what we've found that exists. You have to understand, we're in a very, we're kind of, I don't want to call it a unique position, but there aren't a lot of people that do what we do for two reasons. Number one, if we're only 50-50, over the life of a fund manager over a contract, they absolutely love us. Why? Because we've made all of our money when the market tanks. We give them the money and they buy a lot of cheap shares, and we lose all of our money when the market goes up. They're already up, so they're going to do. So we lowered their standard deviation, increased their long-term performance, and absolutely make things like their Sharpe ratio go through the roof.
Yeah.
So we don't actually have to make money. We just have to end up protecting, and lower their risk, and that obviously helps with their long-term returns.
Mm-hmm.
One of the things that people don't end up realizing from a asset manager, if they lose 50%, right, they need to make 100% to end up getting back to even. So for us to be able to take some of those bigger losses away, it really, really helps their long-term performance.
Mm. Mm. Well, I know one of the things we did in our curriculum is I applied we looked at the overlay approach with covered calls and protective puts, and I called it a modulating collar, where there were certain technical conditions where we would apply the put hedge, and then other times when we would lift it all together. And doing it that approach ended up just outperforming just a straight covered call, or a straight, lifting that put hedge at certain times was just really helped a ton on the total returns. And then applying it only in the direst of circumstances and it really helped a ton. I don't know, are you doing that at all? Are you modulating the strikes relative to the technical conditions?
No, that's one of the things that we won't do. Many of our clients will tell us when they want us to do that, but what we end up, the institutional services that we end up doing is that we end up saying we're not technical analysts, we're not a fundamental analyst, we're quantitative analysts. We're only looking to end up buying you the most protection for the least amount of money, and we're going to end up having a full hedge all the time. If they'll sign a waiver and say, no, we don't want it this month. What we found, though, one of the things that some retail, and this might be an interesting thing, is to take a look at how expensive that collar is. Because if you do and we had done some of this work before, I merged my company with by the way, the name of the company is EAB Investment Group. What we would end up doing is we would measure how expensive collars were by doing a simple calculation. We would take, let's say, a standard number, like let's say 3%, 30 days out, 3%, and take a look at how much money are you receiving for the call and how much it's costing you for the put, and measure that as an indicator. Because when the put gets to be much more expensive than the call, what you'll end up seeing is that there's a lot more, I'm going to call it institutional fear, right?
Mm-hmm.
People are willing to pay more for protection. So what you ended up finding back in January was that, let's say that on your index might end up normally being 60% on average, meaning that the put 3% above, the call 3% above the money is only 60% of the value of the put 3% below the money. So you can end up watching that as a percentage, and that's something pretty easy that folks can end up doing at home. Okay, all they need to end up having is, links, have your real time, or even do your calculation at the end of the day, and you can end up basically seeing that's a much, much more valuable calculation, I think, for retail folks to know than what the VIX is.
Mm-hmm. Yep. Okay. Well. No, good stuff. I mean, and we've had some clients using Option View over the years that's what they do, or option overlays on portfolios, and all that. That's good stuff. I mean, so they tell you when they want to lift the put side, and they have their models that I take it that they're using to tell you that, and then you find the most efficient way to apply those.
Yeah,
That's
like
great.
for example, like if we have an institutional client, okay, they'll end up saying, no, listen, we don't want to end up having a full hedge right now because, we're extremely bullish, tone down the hedge to only, 50% on full throttle.
Okay.
So that's what they'll do. But we won't make, all of my partners were guys like, for example, a founding partner was one of the risk managers for Goldman Sachs, and he was their quantitative vol arb guy to protect their internal portfolios.
Mm-hmm.
And so, another one of the partner was the biggest floor trader, independent floor trader on the Philex for many years.
Okay.
And so, I mean, these guys have been doing this for a long, long time, and so we don't try to, the only thing that we're doing is that for one company, we'll end up running a hedge on the S&P 500. What we ended up saying is that the S&P 500 beats the vast majority of the money managers out there. Why don't we start with the S&P 500 and then build our hedge on top of that? And so, like, for example, last year, that portfolio had a 74 upside percent capture ratio. The market was up 13.5%. This portfolio was up 10. But even though we underperformed, we had a higher Sharpe ratio because we lowered the standard deviation so much. Mm-hmm. So from an institutional point of view, that becomes extremely important. There was a really good white paper written by the SIBO on their different hedges, right, on their covered call at the money, 2% above the money. You know about BXY and BXM and CLL and those things. And one of the things that they ended up doing, which I thought was really good, is that they basically calculated standard deviations of up months versus down months. Mm-hmm. And all of our work will always break things down to how do they perform in up markets versus down markets. And, the thing is, you want to have a very high beta when the market goes up and a very low beta when the market goes down. Mm-hmm. And they kind of showed in this paper, and I'll end up getting the paper so that anybody who downloads this, okay, you'll end up being able to have the link to the SIBO so you can get it. I have to just go and find it again. But it was really, really strong because it showed the difference between the two.
Hey, Steve and Jim, we're right at an hour, so there are just a couple of questions for Steve. Jerry asked about if you used any chart patterns and fundamentals like FOMC and geopolitical events or head and shoulder patterns, anything like that.
No, not for this yet. I certainly have the capacity to. That is, well, not so much with head and shoulders because, there's only a few programs out there in Metastock that could signpost those, and there's just not as many head and shoulder patterns and some of those. I mean, candlestick patterns are things that I've looked at, and because there's just more of those, but the more complex, lengthier patterns, are a bit more difficult to program and then have appear in Metastock that you can go back and just do a statistical analysis of the volatility coming from that pattern. I've done Bollinger Bands. Trying to look at the statistical edge, when Bollinger Bands are narrow versus wide and all that stuff. So I've gone down that road a little bit, but not the chart patterns as much.
Okay, and then Marilyn asked, have you ever looked at this with Ichimoku charts?
Ichimoku. Well, Ichimoku is a part of my weekly regimen when we do our little morning market huddle every Wednesday. But in terms of applying Ichimoku to these, I don't know what indicator or what pattern out of Ichimoku I would look at. I'd have to think about that. I haven't addressed Ichimoku in this context yet. I'd have to kind of noodle on which one of the Ichimoku setups to apply relative to volatility. I guess when price goes into the Ichimoku cloud would be an interesting one, certainly. That would be the place I would start initially, but that's a good idea. I mean, again, I've just kind of came out with this engine a little while ago, and I'm, moving forward with the various catalog of technical approaches to try and extract even a better edge than what there inherently appears to be.
And Tim asks if this could be confirmed with actual option sales with an automated backtest tool like Quanti Carlo. And I'm going to say probably yes, but I think Quanti Carlo, they're working on a capability for you to generate your own trading signals. So based on like your above or below the 40-day line, you could have like a 0-1 if you're willing to take a long trade, for instance. So I think you could do that. I don't know. Have you seen Quanti Carlo, Steve?
I began to look at it last week, and I sat through the tutorial, but now are they at the point when you can put in there, say, start a condor under this technical setup?
I know they do a technical indicator library, so I can pass that on to Larry and ask him.
Okay. Yeah, because the research I'm doing here could certainly be applied to what they do over there if they have the technical setup to apply a butterfly or a condor under certain technical conditions. Then the two areas of research would coincide very well.
Yeah, I can put you in touch with Larry too. That might be interesting.
Yeah, Larry Richards. Yeah, we've connected up over the years.
Okay. And Adrian asks, any chance of being able to show in the analyzed chart the combination of two different options, like the hedge finder, but show the T+0 line, or an option and an underlying?
One more time, because in graphic analysis, we're showing the risk graph of a given trade, and they're asking for, the question is, can we do like a hedge finder?
No. Able to show in the analyzed chart the combination of two different options. So like the hedge finder, but showing the T+0 line.
The combination of two different options.
That sounds like but
that's what it.
Different underlyings like RUT and IWM.
Oh gosh, no. Unfortunately, no. Option View does not have that capability to show two different underlyings.
I mentioned that to Len, and he said you've had that request quite a bit. So hopefully he can actually do that. That would be great.
Yeah. No, that'd be interesting. Two different underlyings for the same option for the. So you'd flip-flop between Russell and IWM, for example, using one.
And then you're making an adjustment with IWM options, something like that.
Oh. Okay. Yeah, we've gone down that road because when people trade the E-mini and the SPX options, and we've had to go down that road a little bit in the past. No, but Len's aware of that. That's good.
Yep. All right. Well, that's the end of the questions, and I think our time's up anyway. So, Steve, many thanks for coming on. It's very interesting. I'm sure we'll have you back because it's always a pleasure.
Oh, thank you so much, Tom and Jim. It's been a pleasure speaking with you again, and I love this stuff. I'd love to be back, and I'll just do more research and hopefully come back and I'll have the Holy Grail. We'll see.
Steve, I love talking to you. Thank you so much. Keep up the great research work. If maybe you can come back and talk to us about your volatility indicator. That one there's a lot of interest in also.
Oh, I'd be glad to. That'd be a lot of fun. We could certainly do that.
I'd like that. Thank you.
We'll find a time to get you on the schedule and have you back.
Okay. No, look forward to it.
Question, somebody asked, what's your email address?
Oh, simply steve@optionview.com. Optionview with the V-U-E. steve@optionview.com.
Okay, I'll just paste that in the chat then. There, that should do it. Okay, so once again, thanks everyone for staying with us to the end, and Steve, we'll have you back soon.
Okay, thanks a lot, Tom. Bye, Jim.
All right, everyone.
Thank you.
All right.